From the time we're young, we're handed a very specific set of instructions: get good grades, master the standard curriculum, and land a stable job. The implicit promise of this path is straightforward. If you put your head down, work hard, and slowly climb the corporate ladder, financial security will inevitably follow. But look closely at the mechanics of that brute force approach. As your paycheck grows from your labor, your tax burden scales up right alongside it. You buy a bigger house, a newer car, and suddenly your lifestyle expenses consume every extra dollar you just earned. Curiously, the education system that prepared you for this job spent years drilling historical dates and geographic boundaries into your head while entirely omitting how taxes operate, how debt functions, or how to actually retain capital. Millions of people across the globe eventually realized this gap in their education through a single phenomenon. A wealth playbook emerged, breaking through cultural and language barriers to explain exactly what the school system left out. The core distinction it draws is mechanical. The default path you were taught dictates that you trade your time to work for money. The alternative path requires you to build systems where your money works for you. When you put all this together, the standard path reveals itself. It relies heavily on widespread financial illiteracy to keep you working for a paycheck, trapped in a cycle of earning and spending that rarely leads to actual freedom. To break out of that cycle, you have to look at how people mislabel the things they own. A typical middle-class earner looks at a new car, a flagship smartphone, or a house with heavy EMIs and calls them assets. The Wealth Playbook classifies these items as liabilities. They require maintenance, insurance, and interest. Every month, they drain cash out of your pocket. A true asset does the opposite. Mechanisms like rental properties, dividend stocks, or automated businesses generate cash independent of your labor. This creates a divergence in focus. A standard employee spends 40 hours a week building the owner's business. Someone utilizing the Wealth Playbook might work that same job, but they spend their off hours building a parallel portfolio of their own assets. That parallel portfolio changes how you are taxed. A standard employee earns money, gets taxed at the highest rate, and lives on what's left. By holding assets within corporate structures, you legally deduct expenses first and pay taxes only on the remainder. True wealth accumulation isn't determined by the gross size of your salary. It is determined by how much of your income is shielded from taxes and redirected into those cash-flowing systems. The shift from one playbook to the other requires changing how you evaluate your time. When looking for a job, the default approach is to scan for the highest starting salary. The wealth approach scans for the highest leverage skills you can extract, like sales, leadership, or marketing. You also have to change how you react to financial hurdles. When faced with something expensive, the middle-class reflex is the definitive statement, "I can't afford it." That statement shuts down the brain. The wealthy replace it with an open-ended inquiry. How can I arrange the money? This forces the mind to hunt for solutions. Then there is the concept of risk. The default playbook treats risk as something to be avoided completely out of blind fear, which guarantees a lifetime of financial stagnation. But the architects of the wealth playbook view risk differently. You don't run from it, you research it. You strip away the emotional fear, understand the mechanics of the investment, and take calculated steps forward. Before your bank account transitions from liabilities to assets, the internal psychological code that dictates how you view fear and opportunity must be rewritten. There is a persistent myth that the end goal of all this financial maneuvering is simply to hoard cash or buy luxury goods to show off to your neighbors. The actual target is a strict mathematical equation called financial independence. This is the exact moment the passive income generated by your assets surpasses your monthly living expenses. When you hit that equilibrium, the dynamic of your life flips. If you decided to stop working tomorrow, your household would still function, your bills would still clear, and your time would finally be entirely your own. But consuming this information is just theory. You can read the books and watch the videos, but if you close this screen and change nothing about your daily routine, the default playbook wins. The bridge between the trap and the freedom is execution. Track your expenses tonight. Set up a small automated investment tomorrow. Take one concrete action, because understanding the math means nothing if you refuse to run the numbers.